Hello and welcome to the Finance Quarter. I'm Andrew Robertson. Private equity is a term we hear about a lot in the world of business and finance, but how many of us really understand what it is and how it works? And as their name suggests, private equity people are normally very private and they don't often give interviews. But Jeremy Samuel from private equity firm Anacacia Capital has kindly agreed to break that tradition. Jeremy, what is private equity and how does it work?
Look, Andrew, private equity at its core is really investing in private businesses as opposed to, say, public or listed companies, and it's investing equity, so investing as a shareholder as opposed to debt. So private equity is really about backing private companies, helping them to grow, and trying to make a good return for the investors and the management team that's investing alongside the private equity firm.
You talk about private equity firms investing as equity partners rather than debt holders, but often when a private equity firm takes a stake in a company, it puts lots of debt into that company. How does that work?
You know, sometimes the headlines do grab those companies which do have a lot of debt. The reality is that, like the general business community, private equity-backed businesses have a wide spectrum of different sorts of financing structures. Some are purely backed by equity and have excess cash sitting on the balance sheet, and other businesses do borrow where they think that makes sense as well. And it really comes down to, I guess, the way we think about it from an Anacacia perspective is, let's start with what the business strategy is. What's the business trying to do? How's it trying to grow over the next 3, 4, 5, 6 years? And then put in place the right capital structure, the right finance structure to support that. So for some companies, that means no debt at all. For other businesses, that does mean that private equity firms sometimes do put debt into those businesses.
Where do you get the money to invest in businesses, and how do you make your money?
Each private equity firm is a bit different, but the typical private equity firm has a 10-year commitment from its underlying investors. Most private equity funds in Australia get their capital from superannuation funds, who in turn ultimately get their money from mums and dads that are putting their money into those superannuation funds. There's also increasingly we're seeing a trend for overseas capital that is focused on trying to find the best private equity managers in the world, and we're fortunate in Australia to have 2 or 3 world-class fund managers who are able to sort of attract that sort of capital. In terms of the second part of your question, how do private equity firms make their money? Ultimately, if private equity firms do a great job investing in businesses, getting involved with the boards and really helping to improve the strategy and the operation of those businesses and growing those companies, then they share in those profits that they then ultimately will return back to their investors. So it's a pretty simple business, private equity. There's you receive some revenue for managing that capital, and the way that you ultimately get wealthy is really if you make a very meaningful contribution to growing those businesses and realising some good capital gains for your underlying investors.
Well, just on that point where you talk about a meaningful contribution, I know critics of private equity accuse the sector of just stripping every asset they can out of a business and then flogging it off for as much as they can. What do you say to that?
Yeah, look, I think anybody that's actually dealt with private equity firms that I'm aware of, would not make that allegation. I think the reality is that the average private equity firm will typically focus at any one time on half a dozen or so businesses. So it's a very concentrated portfolio. They'll typically have 2 to 4 of their investment team that sit on the board of those businesses. They get very actively involved, often much more actively involved than you'd have say, as a public company director. So, beyond the sort of monthly board meetings. Typically, for example, from an Anacacia perspective, we're typically talking to our CEOs 2 or 3 times a week, and we're not trying to fool ourselves into thinking that we can get operationally involved and do a better job than they can, because we've got fabulous CEOs in our portfolio. But it's more about being there to help drive the strategy, ask the right questions, help mentor them, help counsel them. Because what we often find is people running private companies, which is our sort of core focus, it's a very lonely existence running a private company.
Well, Jeremy, I'm sure our viewers have learned a lot from hearing that. Thank you very much for your time.
Oh, you're welcome. Thank you, Andrew.
And now to the second part of our series on private equity. In our last program, we heard from Jeremy Samuel, who's the head of private equity firm Anacacia Capital, on how private equity works and how, despite the odd deal gone wrong, such as the 9 television network, private equity does try to leave the companies it buys in better shape. And if you're interested in the nuts and bolts of private equity, you can find that interview on the News 24 website. One thing I didn't know, though, is private equity is increasingly being used as a succession planning tool by people wanting to get out of their businesses. Jeremy, when we think of succession planning, we think of either handing a business to the next generation or selling it. And when it comes to selling, private equity is increasingly seeing that as an opportunity. Why is that?
It's a good question, Andrew. Look, I think there are many business owners that are now reaching a time in their lives when they're starting to think about, I could continue to manage the business and continue to own the business, or I could sell out. And if I sell out, do I really want to sell to the competitor down the road that I've been competing with for 20 or 30 or 40 years? Or is there another option? And private equity, I guess, presents that sort of mid-ground option where typically the business owner can take some money off the table now and keep some money and some involvement still in the business. From a private equity perspective, what's attractive about it is that if the business owner that's dealing with succession issues still has some capital in that business, presumably they've done a great job getting the business to where it is to date. So it helps sort of align the interest. And at the same time, you may bring in a new CEO or perhaps the existing management team to really help sort of manage that succession from a management point of view.
So the existing owner doesn't actually walk away from the business?
Yeah, not necessarily. I mean, I think from a Anacacia point of view, for example, as an example of a private equity firm, we're always very hesitant when a business owner says to us, we want to sell out 100%, but trust us, there's enormous growth potential left in the business. We don't fool ourselves into thinking that we understand the business better than they do. We do appreciate that they may be in their 50s or 60s or 70s and starting to think about retirement, but the prospect of them holding on to still a minority stake or a small share in that business, we think helps align interests. Typically for them, it's a very important part of their life. It's often like another child. So to actually give it up 100% is a really difficult thing for them to do. So it's often sort of attractive for them also to continue to have some exposure to that business.
How big an issue do you think succession planning is in Australia at the moment?
Andrew, I think succession is a huge issue in Australia. I mean, I think the data shows that Australians in the ages of 50 to 60, for example, have, I think, almost doubled in the last 20 years. Australians over the age of 80 has more than doubled. There's a big baby boomer generation that's sort of coming through. Many of them either haven't got children, or if they do have children, they're not necessarily the natural owners and managers of those businesses. Sometimes the children themselves, that's not their ambition. They've seen mum and dad working really hard in that business, often from right from the leaving school at 16 or as an immigrant. And the kids look at their parents and say, well, gee, I'm now in my 50s and I don't want to be doing that in the same way. And then those people in their 50s, when they then have their own children, those kids are often then professionals. They're in media or law or medicine or science or other areas, and they don't have that kind of ambition. So succession's a really big issue. I mean, I think if I was in government, one of the policy issues that I think the government could spend a lot more time thinking about is how do they help business owners really manage succession? Because it's not just about the business owner, it's then about the thousands of people that are employed by those companies.
So do you see this as a growing part of the private equity industry?
Yeah, look, absolutely. I mean, succession and private companies has always been the core of what private equity in Australia has been about. But demographically, we're seeing in Australia this big wave of baby boomers coming through. So demand is just getting greater and greater. And to give you an example, Anacacia, our firm, we looked at 500 businesses last year. Most of those were succession-driven issues. And unfortunately, we were only able to invest in 1% of those because we're very selective in terms of who we invest in. So there's enormous demand that we're seeing from the bottom up in terms of businesses dealing with succession. And the data from the Australian Bureau of Statistics and other places also clearly shows that this is a big issue for the Australian economy.
So it's not just retirement villages that are going to boom as the population ages?
Yeah, no, I think that's right. I mean, and the flip side of that, I think, is if as an economy we don't get it right and we don't really help those businesses to manage succession, we actually could have some significant problems. I mean, there's 80,000 businesses in Australia with 5 to 200 employees. Small businesses are really the lifeblood of the economy, and therefore how we actually manage that succession planning from the current set of owners that we've got through to the next generation of business owners is actually really critical.
Well, Jeremy Samuel, you've given us a lot to think about there. Thank you very much for your time.
Thanks, Andrew.